Tonight, new calls to regulate the limousine industry in the wake of that horrific crash that killed 20 people in upstate New York. And it begs the question we'll ask tonight, why aren't safety regulations already in place? Also, Election Day now less than a month away, and we'll be checking in on the districts that could decide whether Democrats retake control of the House. And later on, Kanye West visits the West Wing, and it goes about the way you'd think it would. We'll play the audio and let you decide. Good evening and welcome to RFL. I'm Andrew Whitman, in tonight for Richard French. We'll get to all those stories and more in just a moment, but we begin tonight on Wall Street, where stocks were hammered again today. The Dow Jones Industrial Average diving more than 500 points. That's more than 2%. And that follows yesterday's plunge of more than 800 points. Usually when markets sell off, there are a number of factors, but President Trump is pointing fingers at just one place, the Federal Reserve, for hiking interest rates. Here's the commander-in-chief.
No, I think the Fed is making a mistake. They're so tight. I think the Fed has gone crazy. So you could say that, well, that's a lot of safety, actually, and it is a lot of safety, and it gives you a lot of margin. But I think the Fed has gone crazy.
A president hammering his own Fed chief. It is not unprecedented, but it is unusual. For more now, we turn to Miles Udland from Yahoo Finance. Miles, now 2 straight days of market drops, and most people are saying it's connected to interest rates that have gone up with more increases that are likely, and also the insecurity with tariffs. Is that the sense that you're hearing on the street, or could it be something else besides that?
Yeah, I think certainly interest rates are the big story right now. I think what did catch the market's attention is we now have 2 days in a row where President Trump is out saying that he is not a fan of the Fed's policy of raising interest rates. I also think there were a couple earnings reports that happened earlier this week. We saw a company out of Pittsburgh, PPG, say that, basically worries out of China, inflation, higher commodity costs were pressuring their bottom line. We also heard Fastenal, a company out of Wisconsin. These are companies not a lot of people pay attention to, but are big parts of the industrial economy. Fastenal warning about concerns over China, concerns over pricing. And I think investors are looking at a more inflationary environment along with those higher rates that you mentioned as potential risk to the earnings picture right now. And the market has basically been looking at earnings up 20% over last year. That's expected to slow in 2019. I think all of these fears are coming together at the same time, and I think that's leading to that panic action that we've sort of seen in the last 2 trading sessions.
But here's what I don't understand, Miles, because I barely follow financial news. I follow the news instead. But I knew that interest rates were going up and were slated to go up even further, and I knew that tariffs were something of an insecurity. I always thought that the market priced these things in. Why haven't they?
Well, I think what's so interesting about the market is that people in financial markets knew that information as well, but you wait until the last possible minute to price that stuff in, essentially because you're not really sure if it's worth pricing in, right? If everyone knows interest rates are rising and the market in general is comfortable with that, well then why are you going to revise your assumptions before anybody else does? And so what's very interesting about markets is that yes, it's mostly computer-driven trading. Yes, it's a lot of flows from retirement accounts, other things that are passive instruments in the market, but ultimately it's made up of people, right? And people move in packs. And so what's been interesting is, yes, those stories are in the background. Yes, we know that these things are happening. Mortgage rates are going up. We're getting to 5% on the 30-year fixed, give or take. And it takes a couple of weeks for people to kind of look at each other and say, all right, well, I guess this is happening. And so we saw it in the beginning of February where we initially started to see rates go higher. The 10-year Treasury yield got above 3% for the first time. Markets sold off. Then we kind of climbed back higher to record highs throughout the summer, and then it's happening again. And so it's been a very interesting pattern. But I agree that there is a little bit of confusion to say, well, what took you guys so long? And all I can say is that's kind of how the market seems to be set up right now.
And just for our viewers who aren't necessarily business channel watchers, remind everybody again why interest rates are such a big deal.
Yeah, so interest rates, they're being risen by the Federal Reserve, which is setting their benchmark rate higher. Interest rates affect the rate that you are paying on your credit card, the rate that you're paying to pay off your car, the rate that you're paying if you're going to buy a home or refinance your mortgage. So really everything that you have in your financial life, anything that you are indebted on, student loans, for example, the rate of interest that you are paying goes higher. We have had interest rates at record lows for 8-9 years after the financial crisis. They are now getting back towards levels that we saw before the crisis, not quite that high, but in that ballpark. And so higher interest rates are something that someone like myself, who graduated college 5-6 years ago, I've never seen rates higher. So I think a lot of people who are now in the workforce, they've been working 5, 8, 10 years even, have not seen their rates on some of these core parts of their financial life, move higher, and that's going to affect the way that they think about their own household finances going forward.
You mentioned the president's criticisms of the Fed for raising interest rates. Some people saying that that's improper, but let's put that off to the side. Just so we're all clear, what would happen if the Fed didn't raise interest rates, if it followed what Trump wanted?
Well, I think right now the Fed is considered a politically neutral institution, right? They can act based on what they see as the need of the U.S. economy, the rate of interest that the U.S. economy needs to continue operating at full employment and to continue to see stable prices. So were the Fed to stop raising interest rates, it is expected they'll raise interest rates once more this year and then 2 or 3 times in 2019. If they were to go off of that course, it would be perceived by markets as them reacting to politics. And the whole point of the Fed is that they don't have to react to politics. And so they're really kind of in a stuck between a rock and a hard place right now, because they're sort of damned if they do, but they're damned if they don't. And so I think it's a very interesting story to see play out over the next couple of years, especially since it's been quite a while. It's been about 20 years since we've heard a president talk about the Fed at any sort of length. And so I don't expect the Fed to stop on its path right now. I expect them to go out with what they've forecasted to markets. But that is definitely something to keep in the back of your mind as we head towards, the 2020 presidential election cycle. I do not expect that Trump or the, potential Democratic candidate will stop talking about the Fed, which is really going to put them in an increasingly, let's say, fragile political position.
We saw something like this in the early 1970s. President Nixon was critical of the Fed Reserve for raising interest rates, so they slowed the increases, which then led to some of the stagflation and inflation that we saw in the 70s. Basically, it was the Carter economy that everybody poo-poos in the rearview mirror. Nobody's really made the point that the president seems to be calling for policies that led to Carter-era financial indications. But let me move on. We've got 2 days of sell-offs, which is certainly worrying. How much more, how much longer is it before this is something more than just worrying, before it's a problem?
I think if the market goes down 10% more, it's probably still fine. It is very rare that the economy is derailed by something that happens in the stock market. The stock market is usually the collateral damage. Yes, the stock market went down 30, 40, 50% during the financial crisis, but we know that the financial crisis was really about the housing market. It was about the commercial banking market seizing up. And so even if the stock market were to go down 10% more, 15% more, I don't think that it would slow the momentum that we're seeing in the U.S. economy right now. There is a point at which consumer confidence would be dented by the stock market going down, but we've seen confidence really rising among the lower third of U.S. incomes, and those are folks who by and large are not exposed to the stock market. They're going to be much less sensitive to moves in financial markets than households that are higher earners, and households that are higher earners are not really where we see the impact from consumption. The consumption boost or the decline is coming from folks who make less money. So if you're in the bottom third of incomes, you likely, 1, don't own stocks, 2, you're likely getting a raise. So I think that as long as those two conditions remain in place, we will continue to see the U.S. economy do well, and I don't think that a 15% decline in the stock market would make the economy at large sort of seize up.
No, not until we get to somewhere where we were about 10 years ago, when the bottom portion of income earners certainly felt the impact coming from the stock market. Miles Udland of Yahoo Finance. Hopefully we get a little more calm in the markets tomorrow. Thanks very much. All right, we'll take a break. When we come back, still more questions than answers about that limo crash where 20 people were killed in upstate New York. One big question, was there anything that lawmakers could have done to better regulate those massive stretch limos that have a history of tragic accidents?